Hello and welcome to Sectors Up Close. I'm Ramzan Karmali. Today we're taking a look at US regional banks, and my guest is David Sekera, Chief US Market Strategist at Morningstar. Regional banks across the US have come under intense scrutiny in recent months. The collapse of several regional banks, including Silicon Valley Bank and Signature Bank, as well as the troubled acquisitions of both Credit Suisse and First Republic Bank, led to many financial industry observers becoming concerned about the banking sector and about the health of the economy in general. Chief perhaps among these concerns are the impact of higher interest rates, as well as the United States economy possibly slipping into a recession. It's no surprise that the S&P Regional Bank Select Industry Index has fallen dramatically, down over a third year to date. And so far, the rescue of First Republic Bank this week has failed to arrest a sell-off in regional bank shares. Investors seem to be still analysing whether JP Morgan's takeover of the troubled Californian lender means that the worst is over for the sector. The fact that the second largest banking failure in US banking history had a mostly private solution may eventually ease worries. But even JP Morgan CEO Jamie Dimon declared after the takeover that this part of the crisis was over. Does that mean there's more we need to worry about? Well, to help us answer that and more, I'm joined by David Sekera from Morningstar. David, many thanks for joining us. Let's start with that question. Is the worst for US regional banks over?
Well, it's always hard to say whether it's over here in the short term, but from a fundamental point of view, we think the regional bank sector, while it's under stress, isn't broken. And when we think about the next couple of quarters and model out our valuations, we do forecast that earnings are going to drop sequentially over the course of this year. But according to our equity analyst team, we think they'll start bottoming out either in the fourth quarter of this year or beginning in next year, and then should start moving back up. We do think that, yes, there may be some other bank failures out there, but of the regional banks under our coverage, we think that right now the market is probably overreacting to these short-term pressures and have pushed valuations down just too far.
And what have you made of Q1 earnings, and in particular deposit outflows?
Well, for most of the regional banks under our coverage, the deposit outflows were actually quite modest. And in fact, when we look at our coverage, I think Comerica was probably the exception. Deposits dropped by 9%, and then Cullen & Frost and US Bank were probably the next worst at down 4%. But having said that, with the rest of the regional banks, they were usually only down like 1 or 2%. So while we do think the earnings in the sector have already peaked, they will decline sequentially. I think the main factor for the decline is really just the expectation that net interest margins are going to continue to constrict, probably for the next year. So we do think that things will start to stabilize, but it's not going to be probably until the end of this year or beginning of next.
And what do you think is the biggest risk to regional banks at the moment? What's the biggest factor out there that you think this could cause problems in the future?
Well, certainly the commercial real estate exposure is getting a lot of attention right now from investors. But I would note that we do think that commercial real estate exposure is going to be manageable. Now, the three that we would highlight having the highest exposure to the commercial real estate is Cullen & Frost, M&T, and Zions. But even then, we estimate that their total commercial real estate exposure is only about a third of their total loan book. The area that we have the most concern within commercial real estate is going to be the office space, and even more specifically there in the large urban areas. We have seen pretty slow return to office. In fact, if you look at the Kastle return to office index, occupancy in a lot of large cities is only still around 50%. But then like the suburban and the rural office areas are not at much risk there. So on average, the loans made for offices are only then about 10 to 20% of that commercial real estate exposure. So really of the total loan book, only 3 to 5% is the office area where we have the most concern.
And obviously regulation has come under scrutiny as well here. What regulatory changes are you expecting to see?
If the regulators force the banks to have to recognize those hold to maturity losses in their capital ratios, we do note, some of the banks actually in the short term would fall short of minimum capital requirements, but we just don't think it's realistic. We don't think that regulators would make any drastic changes like that in a very short period of time. And even if they did try and put that through, there would certainly be a phase-in period. So in that stress test analysis, we do assume that if we go out to Q4 2024 and they do recognize those hold to maturity losses, in that case, the banks under our coverage would actually still meet the regulatory capital levels.
And with share prices so much lower than they were at the start of the year. Are there any regional banks out there investors should consider right now?
Sure, there's three of them that I would probably highlight to start off with. So first one is going to be US Bank, and I would say that of these three, this is the one that probably is going to be a little less risky. Now, we rate that stock 5 stars, which is our highest rating, and it's currently trading at about a 47% discount to our $58 fair value estimate. Now, they only suffered a 4% decline in their deposit base. The next one I'd highlight, a little bit more of a risky situation, but again, trades at just over half of our $57 fair value estimate, 5-star rated stock, Truist. Now, one of the big reasons for the sell-off there is they do have a higher than average amount of uninsured deposits, yet in the first quarter, they only realized a deposit decline of 2%. We think the market's just pushed that stock down, too far. Then lastly, the one that I would say is probably more indicative of a slightly stressed situation, but ultimately think will be manageable. The stock's trading at less than half of our $79 fair value estimate, and that's 5-star rated stock Comerica. Now, they did have a larger than average decline in their deposit base of 9%, but actually that's still a lot less than I think what the market had initially feared. At this point, I think the market's pricing in either that one, it's going to be unable to earn its cost of capital over time, which our analyst frankly just doesn't see, or that the company could be forced to make a highly dilutive capital raise. Again, our analyst doesn't forecast that either.
David Sekera, many thanks for that indeed. David Sekera from Morningstar. And that is your roundup of US regional banks. I'm Ramzan Karmali, and this is Reuters.